November Switzer Report webinar. I'm Paul Rickard. Joining me today is Peter Switzer. Peter, good afternoon.
Hi Paul, how are you going?
And our special guest is Michael Wayne. Michael is the Managing Director of Medallion Financial.
Thanks
Michael,
for having me, Paul.
welcome to our webinar.
Thank you.
Before we start, just a few things to go through so that we just set a couple of things up front. First of all, we don't know anything about your particular circumstances, financial situation, or individual objectives. So obviously the advice, what we're talking about today is going to be more general in nature. We're going to give you some opinions, but as we always say, we don't know whether it's right for you. So before acting upon anything we say, we always suggest to you that you probably should seek the appropriate professional advice. So that's the obligatory disclaimer out of the way. Also, just a couple of housekeeping matters. Please close all the applications and programs that are not in use. We suggest that'll make it easier. Please ensure the volume on your computer or speakers is turned up to a comfortable level. This is about the volume you'll be hearing us. And of course, this is an interactive webinar. Now, we've already got some questions we're going to come to in a couple of minutes, but of course, you can send them in during the webinar. You can use the questions box, which hopefully should be around the right-hand part of your screen. And of course, if you've got a microphone and you tell us you've got a microphone, you can ask the question directly. We'll unmute you, but you need to let us know you've got a microphone. Just say a microphone and we'll get that through. The other thing is to let you know is we try to keep these webinars to exactly an hour. We know many of you have got other commitments. So it's just after 12:33 p.m. Eastern Daylight Time, and we will, if you need to get away, you'll know that we'll finish no later than 1:30 p.m. Eastern Daylight Time. So with that sort of introduction out of the way, let me move on. I pinched this from CNBC, Peter and Michael. This was looking at the Dow Jones in the month of October, and some big moves there, and we saw the impact in Australia.
Yeah, so, and Paul, so these are telling us the individual components?
No, this is the Dow just on a day-by-day basis in October. So from the 1st of October through to the 31st of October. So some big swings, a big move of 832 on the negative side to 548 on the plus side. Overall down a bit over 5%. But
and it shows the impact of computer trading and artificial intelligence and algorithms.
Some window dressing there the last couple of days of the month, I think, for some of the funds to make their balances look better. It was a terrible month, but I think the thing to take away from this, if you look back over the last 10 years, there's been about 25 corrections of greater than 5%. So the thing that investors need to work out is whether this is the start of something more sinister or just one of these many corrections that we've had over the range.
Okay, so I would probably call our readers, our subscribers out for you, Michael. What's your view on that?
Look, we think it's a correction. The fact is we have seen many of these pullbacks, and in many ways healthy. Some sectors and some businesses got too far ahead of themselves. But when you look at the corporate earnings, they're very strong. I think they're going to be up around 26-27% for this quarter in the US. The global economy is still okay. The US is still very good. But I understand the market's fears in that what is to come next. The US has obviously performed very well. The US economy has performed very well. But what happens once interest rates start to bite? What happens once tax cuts wash through the system? Are these trading tensions going to continue on? So there are a bit of recalibrating expectations when looking at earnings growth 2-3 years out.
Okay, let's move on to the Australian market. October down 6.1%. Price index, the accumulation index, of course, adds back dividends. So we're still negative year to date now, negative 0.5% on the accumulation index and the ASX 200 down almost 4%. I just think the other interesting data point there, Peter, is the top 20 is actually done a bit better this year. So that includes, remember, there are 4 banks in that number as well.
Yeah. So imagine if the Royal Commission wasn't on.
So
those figures would be a lot higher, and our index would be a lot higher.
Yeah. So it's the top end of the market that actually is keeping this market up a little bit and reversing a trend of at least 2007 and 18, and the underperformance here of the small caps, which. Perhaps, are you surprised to see that, Michael?
Oh, look, I think it's definitely been a theme over the last 5 years where the small mid-caps have significantly outperformed the ASX 20. And I think the divergence between what people are calling growth, valuations and value stocks is the widest it's been potentially in history. So I think it's only naturally time to get a bit of reversion, and we've potentially seen some of that, because obviously you've had a lot of the high growth, high P IT names, healthcare names come back a long way, and obviously that money needs to then find a home somewhere. So people are finding refuge in the utilities, for instance, or maybe some of the telcos or the banks, some of the bigger names that have helped prop things up. The miners have held up as well. So it is a little bit interesting that we're starting to see this, and is this again the start of a mean reversion where more stocks or more investment money goes into stocks in the ASX 20, the larger, more stable, lower valuation names, or is this just a fleeting moment where people have seek refuge?
Yeah. Well, I know a company like NextDC, and NextDC always looked like a very good company, but probably 2 or 3 years ago, no one was buying it, and then all of a sudden, everyone wanted to buy it. You know, it's just like WiseTech and Afterpay, of course, is another story. But we know that those sorts of small to mid-cap companies, they were overbought, weren't they? And so I think a lot of people have realised that they're overbought. At the same time, the top 20 did terribly for at least 2 years, Paul. And so it just seems the value's there. And let's face it, I think when you get scared, you want to go back to big names.
Okay. That's right. Let's move on. All sectors in the red in the month of October.
Interesting table, isn't it?
Yeah, still healthcare leads the way. And again, if you put this into the first couple of days in November, that would be even higher. So we've had a big rebound in CSL the last couple of days, and IT. It said that what's really holding the market back is financials, which of course is the biggest sector. It's still down 8.1%, and that's very divergent. Of course, there are some companies in financials, Macquarie, ASX, Suncorp, some of the insurers are actually up year to date. So this is really still the four big banks and the regional banks that's killing it. Any other sort of take because we've got some big questions here we need to address. Any other comments you want to make, Peter or Mike, on those numbers?
Well, I just think that it screams out to me when you see our financials down 8% year to date. You know, if you do believe in the contrarian play, our financials are a pretty safe contrarian play, because even if you don't get the capital gain you expect, you're still going to get the dividend. And so I think that it seems to me over the next 12 months, once the recommendations get out of the way, I think Bill Shorten will also hurt bank share prices.
Hold their invitation this
year. So it's going to hold back our index and total, but eventually, I guess, post-election, once we know exactly what he's doing, maybe they'll rebound. But there is a big problem for our financials.
Okay, let's move on to the questions we raised and the next generation of blue chips. So first of all, your current favourite blue chip. I'm going to start with you, Michael, first, right? So.
Look, I think it's not going to become a huge surprise to people. It's something like a CSL. I think, given the recent pullback, would probably be the favourite blue chip. That's made its way up to, I think, the 4th largest company now.
Did get to number 3, I think, briefly.
Yeah, so who would have thought? I mean, 5-10 years ago, it wasn't even in the realm of being in the top sort of 5 stocks, but it's had a very good run. But despite the good run, it's come back a lot in recent months. So peaking at around $230, made its way all the way down to $175, around that level. It often gets referred to as being very expensive, trading on a very high PE. Its PE actually came back to its 5-year average in the recent pullback. And what people don't really understand or often overlook with CSL is that there's a lot of research and development that goes into that business, and they often expense that up initially in the immediate first year rather than spreading that over a 5 or 10-year period. So it has the effect of actually depressing their earnings a little bit. So yes, it is expensive relative to other sectors and other stocks, but it's probably unfairly dealt with when looking at PEs alone.
I noted a little announcement the other week. The government signed a 5-year contract worth about $3 billion. This is the Australian government to buy influenza and other vaccines from them. So they're not going away, are they?
Well, it's not just in Australia, not even developed nations, but there's all the emerging countries that are really increasing their expenditure on health, and CSL's in the prime position with their history, their scale. They can guarantee sort of a supply chain of blood plasma and other vaccines that other companies just simply can't keep up with. So they're very well entrenched globally.
Okay, Peter, your favourite blue chip, current blue chip?
Yeah, look, I like BHP, but I think, and the target for now is just still $37. But with the announcement of the buyback and whatever, it probably going to lose a bit of momentum out of that. I'm going to play my safe game, and I think something like IOZ or STM, just buying the index.
So we're talking off air about Macquarie, right? So you're not saying Macquarie is a blue chip yet?
Macquarie is definitely a blue chip.
Is that your favourite as well?
Well, it's my personal favourite. I bought it at 26, and you see where it is now.
Yeah.
And it's the biggest holding I've got, and so I like it. But it keeps staggering me. But
is it a blue chip?
I wouldn't.
Is Macquarie a blue chip?
Without a doubt.
Well, it's in the ASX top 10.
It is, yeah.
It's had a big track history.
But I would buy Macquarie on dips now.
Right.
Yeah, because let's just face it, a crash will happen over the next 2 or 3 years.
And it'll affect their
It'll
investment.
go down to 60 bucks. That's when I'd buy Macquarie again, because I think their model is now a good model.
And we touch on a good point. What is a blue chip? It's a very ambiguous term. Is a blue chip
It's
a
not
well-known household name, or is it a company with a strong balance sheet, consistent earnings growth, those sorts of things? So it's up for interpretation.
What's your favourite blue chip?
Well, look, I was going to say CSL only because I can gloat that I've just won the Australian Investors Association Award for last year's tip for their conference.
And what did you tip?
I got the prize today, so I'm just gloating.
And what did you tip?
I tipped CSL.
And what price was it?
$120 at the time, and it returned 55% last year.
So all the experts,
the Roger Montgomerys, all the other fund managers who
Jeff
went to that
Wilson.
conference, Jeff Wilson's, I won the award, So,
and as I said, I threw my weight in with this bloke here, and he's delivered.
I haven't had the courage to buy CSL in this dip yet.
Really?
No, I just...
But you hold a lot of it anyway, don't you?
Never know. Well, I have a bet. I just thought it maybe come back a little more. Maybe I got a bit too greedy, but I think we've probably seen the bounce in CSL. In other words, we got the dip. I'm probably still going to say CSL as a blue chip, because I think it's the safest and the most reliable in terms of, I think, dips on that stock are going to be bought. And I think the buybacks are going to have fantastic opportunities to lighten off in the resource companies. And so, people who are owning Rio, accepting shares and that, same with BHP, that's fantastic news. So that's probably where I'm at. But
I can just throw one company out there for you to consider. TWE, the Treasury Wine Estates. It clearly has performed brilliantly over the last couple of years. And given its, what's happening in Asia and China and whatever, is this a company that's going to one day be seen as a blue chip?
Look, I think with these consumer stocks, they can be a little bit cyclical, and they can change with consumer taste.
People give up on wine?
No, but they change the taste and the fashion. So it's very difficult to see it emerging as, say, a top 10 staple.
We're going to cut it there.
Okay.
But this is a quick question. Up and coming mid-cap stocks, okay? Michael.
Yeah, I mean, recently we had an announcement from a company such as ResMed. So that's by market cap, would be amongst the top 20 ASX
It's getting
companies.
in there, right? It's certainly probably top 30, I guess.
Yeah, and I think by market cap, it's actually top 15. It's not the official top 20, but given recent rallies. And that's a company that, again, captures the aging population. Also, it's
so
also
they're involved in sleep apnea,
sleep
right?
apnea.
And don't they? Isn't the question mark about ResMed about whether there will be a competitor at some stage? They're sort of very dominant position in the marketplace.
There is a competitor
it's
somewhat
a global
with
marketplace,
Fisher and Paykel, global marketplace. There's about 12 million Americans, for instance, that suffer from sleep apnea, but only about 5 million being diagnosed. And that's just the US alone before you start.
They're like the CSL, they're the number one globally.
And their balance sheets as good. And their balance sheets had consistent, we look at the key metrics, revenue, earnings, margins, return on equity, all have been constant or growing over the last decade or so. They did an acquisition a couple of years ago, Brightree, which is a technology acquisition, which allows them to capture data in real time, and that way allows them to target their research and development a lot better than some of the other competitors, such as Fisher and Paykel, for instance. So that's a very high quality one. Another one's Aristocrat Leisure.
That's mine.
I'm going duplicating over a couple of them.
Stealing my way.
But these are the sorts of businesses that you want. That they're new age businesses. They're somewhat overlapping with technology. They're capturing a lot of data. They're moving into markets that are expanding. And I think that's where you're going to find these mid-cap stocks or these emerging businesses that make the transition into the new age blue chips.
Okay, two from you, Pete?
Well, Aristocrat Leisure I like, and you know, I know Charlie's been rabbiting on about it for a long time.
A lot of people don't like investing in that because of ethical issues, right?
That's right. But if you don't have an ethical issue, looking at what the analysts think, there's 26.8% upside. Even if they're wrong by a factor of 50%, a 13% gain's not bad. And look, this one, Bellamy,
out with it.
well, Bellamy's worried, you know, like, I hate saying it, but at the moment it's $8, and it really just jumps around like a Mexican jumping bean, doesn't it? But it really is in the right space, isn't it? You know, selling milk stuff to China is not going to disappear. But it just seems to me that they've had something wrong with that company, and then some regulatory issues come along and knock it off its perch. But the analyst think's got a 29% upside. So once again, that to me, I wouldn't be negotiating any more than say 2 or 3% of my portfolio. But if you want something, particularly the current prices at $8.03, not a bad.
I was looking at Bellamy's yesterday for a client and a subscriber, I should say, and I sort of one of those stocks I just don't know enough about the Chinese risk. There's some announcement comes out and it gets knocked off. I mean, you're right. It's a good business. It's just a question about how do you play that.
So buying it on a really severe dip, it has worked out being a very good strategy.
What do you think about Bellamy's?
Well, the things at the moment, there's a big regulatory hurdle they need to clear, and I think that's what's set it back in the last couple of months or so, where the regulator in China keeps pushing out the date by which they're meant to get some sort of outcome. I'm a bit concerned about it because of the regulatory risks that they do have. There's no doubt that the Chinese consumer is going to continue to grow. Demand for infant milk formula is very strong and likely to continue to grow. But when there is such a great amount of profitability within a certain sector, you start to get other entrants coming into the market. So recently you've had obviously you've had the existing A2 milk, but you've also had companies like Nestle now starting to have quite a big presence in infant milk formula, and it is starting to maybe eat away potentially at their market share.
But Michael, wouldn't they be potentially a takeover target?
Oh, absolutely. If one of these established brands wanted to come in and get a foothold, someone like a Bellamy's.
Okay, we're going to move on because I've got lots of questions. My two are Link Administration, which is the, I just think that's
is it a good buy now, Link?
I think it's a good buy now. They're digesting their UK acquisition. I think it's a good buy now, but they're of course
involved in PEXA.
Well, the PEXA thing might happen. So they're involved in super administration, and which I think has got, there's some challenge with the government, but good long-term tailwinds, and of course they're involved in registry businesses and what they're doing in the UK with sort of managing fund managements, not the fund manager, but managing the back offices of fund managers. So, and the other one, I think Reliance, which is which really has very great track record in the US with plumbers. Got a competitor, and obviously the US home market might be turned down a little bit, but I think they're a great company. So maybe not at these levels, but they're ones too. I think they're both blue chips in the making.
And the analyst believe Link's got 15% upside, Paul.
Yep. So let's move on. We've got some questions here. The new hybrid. What was that? I didn't know that would come up there, but look, I'll give you my comments. Sherman is, look, typically these new hybrids come in at better margins than the old ones. That's where they're trading in the market. So what you see is the older hybrids get sold off, and that's exactly what occurred yesterday in the marketplace. This one I think is going to price between 3.7 and 3.9. Look, it looks all right, but one caution in the hybrid market. If you're worried about dividend imputation, the hybrid market will be as impacted by anything else by dividend imputation, arguably more impacted if Bill Shorten's thing goes through. So that's my little caution on hybrids at the moment, and that's one of the reasons they've got it a bit cheaper. So, but bank ratios, capitals are strong, and so there's no risk there. So, I mean, I reckon this one would probably, given its CBA, is probably about the right level. So what do you think?
Yeah, I mean, CBA did a hybrid Pearls 10, I think, earlier this year, and that priced at a lower.
Yeah, but it's about 3.2, I think.
That's right. So this one's more attractive, and that's probably a combination. Things Royal Commission, the decline,
bank shares selling off.
Bank shares selling off. So in isolation, this seems fairly reasonable. Hybrids are a lot more complex, I think, than people give it credit for. Not every hybrid is the same. There's a lot of different terms that need to be considered, and it's almost a specialized form of investing in of itself. We typically look more at the hybrid ETF. So there's a hybrid ETF, which is basically an actively managed portfolio of hybrids, because there has been examples in the last sort of 3-4 years where hybrids have actually sold off a lot. So in some cases, you're getting the upside of a bond or a fixed income security and the downside of an equity. So the way around that as an individual investor, we find, is just to do the hybrid ETF. But I did a quick bit of research before today's webinar looking at the performance of hybrids around the GFC, and they fell about 25% versus the index, which is close to 50. So they do eliminate some of the downside risk, but not all of it.
Yeah, I think the other thing to bear in mind is that there is a relationship between bank ordinary share yields and hybrid yields. The hybrids lag. And of course, you've got banks all yielding over 6%, 6.5% in some cases. The hybrids, arguably, there's a case they should even be higher. So, look, I think it's okay because it's CBA, but I don't think this is no bargain basement issue, right? No. But the older issues will sell off, and I'm surprised they haven't sold off a little bit more.
And Paul, during the week, Michelle Bullock from the RBA did a speech, and one of the things that she said there, which I'm going to talk about on Monday, is that bank balance sheets are really good.
They are. Yeah.
And so if you're betting on hybrids,
capital risk on this is really low. Right? Exactly. It's just a question whether there'll be one.
And that wasn't a headline in the friggin' newspaper. Excuse me. Excuse the French.
Okay, let's move on. That's CBA Pearls 11 was announced on Wednesday. If you hadn't caught up with that. Okay, APA shares and their takeover, and this is a good question. I've actually inherited some APA shares recently. This is the pipeline, and I guess it's probably a bet on whether you think the takeover is going to get approved by the Chinese, the company connected with a. Yeah. Michael, what's your view on this one? Do you sell now or do you hang on? What do you think of it?
Normally, the way I play this and help clients do it is to take a bit off the table because you're not sure if it's going to get regulatory approval. It's got to pass the Foreign Investment Review Board, and let's face it, it's getting tougher and tougher to get things over the line these days. So it is trading at a bit of a discount to offer price.
The offer's $11.
That's right,
and it's around $9.69 at the moment. Yep.
That's right. So it's trading higher than when it was before the announcement was made, which is around $8.50. Yep. So you're in the money. I would be tempted to take maybe 25% off the table, even half, and that way you can sort of take the risk that it doesn't go through.
What do you think, Peter?
Well, I haven't thought about the APA offer, but I do always remember Rene Rivkin saying that usually when there's, how many offers have they had so far?
There's only one.
Just one, yeah. Usually the first is not the last. But you're right. I like your idea. Take some money off the table and go along for the ride.
Because it wasn't.
I think Ferb might say yes. I think there's a good chance the Treasurer will say no. This is, to me, looks like Woodside of 2000. And there's a lot of, talkback radio's full of this stuff. I reckon there's a good chance that ahead of election this is going to get the flick, and that's why it's trading at a big discount. Yeah. So.
And APA is in a significant infrastructure space as well.
Well, people say it is. If you look at it, you look at the math of gas pipelines, you can argue it is because no one else. How many? You don't have multiple pipelines, right?
That's right.
Doesn't matter who owns it. I think you can make a case it doesn't, but that doesn't mean the shock jocks don't. And, and others don't.
Our gas is now being controlled by China.
Yeah. So. Look, you're right. It's above where it was trading. It was about $8.50. It's now $9.69. I mean, I looked at whether I wanted to raise some cash, whether I should sell my APA, and it's probably just come back a bit too far. But I think it's not a bad strategy to look at selling some.
Yeah, because obviously rising yields as well for a company like this was a negative before the takeover. It's quite a mature business which has grown through acquisition, but also now the ACCC's limiting the amount of acquisitions that APA can do because they're becoming too much of a monopoly. So I think there are a lot of negatives for this business that mean that I'll probably be taking this as an opportunity to get out.
Okay, let's move on. A question about Avio, which of course is in the healthcare or aged care sort of business. In fact, Tony Featherston covered this the other day. And of course, we're now got a Royal Commission that's been announced. And that was responsible for the price drop. What's your views on Avio?
Yeah, it's not one I cover in too much detail. Obviously, no, it's in the aged care space. And this is a sector that is, again, quite regulated. So you've got a lot of costs that you just have to put into this business, such as a number of staff per head. There needs to be certain hygiene requirements and things like that. So often, also, the revenues are capped in many ways by the government and what you can start charging people. So I find that margins can get squeezed with these sorts of companies where there's just too regulated on the revenue, costs are very high, and obviously you've got the impending Royal Commission where we've seen with the banks that negative sentiment can linger around for a while. So not one I know too much about, I must admit, but that's my general view of that overall space.
Yeah, have a look at Tony Feathers. article. I mean,
What did Tony say?
well, I think Tony's view is that they're going to be cheap.
Yeah.
But I mean, what we saw with the Royal Commission was they actually got worse as the Royal Commission went on.
Yeah, it's true. It is true.
Now, this is not the same inquiry, and who knows where they'll head it. But you have to think
it's going to be bad news stories.
There's bad news in this sector, and
the journalists were all over
and
like a cheap suit.
I think it probably goes lower. I mean, it fundamentally looks cheap on all the metrics. If I owned the stock, would I cut my losses? I'd probably be paring it back a little bit. But
well, the target price is $3.10. That's a 70% upside.
Yep.
Now that's the belief, but you're right. There's a timing thing, and I can tell you this. I know journalists pretty well. They will be all over this, and it will be bad.
And it's hard not to think there's going to be some horror stories out there. I mean, if you had an experience with aged care, and as I have, and seen, what happens out there, you just can't believe they're not going to come out with all sorts of stuff, right?
And we've seen pressure on the aged care space now for a couple of years. You've seen STR under pressure, Japara, Regis. So the space overall is out of favour. And although the macro makes sense, aging population, more people requiring these services, the economics of it and community expectations versus shareholder expectations, I don't think really marry up with this.
Okay, so we're sort of suggesting you might want to do a little cutting there. Okay. Look, I wrote it, but this question from Hugh is about the Rio buyback. I can answer this very quickly. Hugh, no, Labor's changes won't have any impact. They've said that it won't, if it is passed in time, it won't apply till the start of the 1st of the July 19 tax year. This dividend will be paid in this current tax year, so you don't need to worry about the Labor Party's plan in regard to the Rio buyback. Okay, so let's open the floor, and I've already got a lot of questions in, so I'm going to go straight to the very topical one. So this one's from Graham. He says he's overweight Telstra.
About what price?
And should I sell some? Michael, where do you stand on Telstra? You at Telstra's bottomed, or you at Telstra's sort of a...
I don't know. That's the thing with Telstra. I was a lot more confident in calling it a sell when it was, $5 or $4.50. But it's got to the point now where it's looking okay from a valuation perspective, although I do think there are still immense competitive pressures across a number of their products, whether it's the NBN or whether it's the mobile network. I mean, Telstra used to always be known as the premium mobile provider, but they've started to lose market share even in that business in recent years. So look, this is a company that has struggled to grow its earnings over a long period of time. Its dividends have obviously recently been cut. There's ongoing competitive pressures from a lot of emerging companies across a number of their different products. So I still think there are too many question marks to jump in right now. There's also that big earnings hole that everyone was calling out about 6-12 months ago. Those payments from the NBN are ceasing. So there's a big hole that needs to be plugged. And how do they go about doing that? Through either a large-scale acquisition or a series of smaller acquisitions. And there's been evidence that their ability to acquire smaller firms or develop smaller businesses hasn't really gone too well in recent times either. So I'll steer clear, neutral for now.
Yeah.
It seemed to me Telstra jumped because two things happened. First of all, quite a few fundies and made a bit of a noise about how it looked like it was cheap, and then all of a sudden we had the sort of the so-called merge between TPM or TPG and Vodafone took away a competitor, and that was going to be a huge boon to the incumbents, as we only had 3 versus 4 is a lot more comfortable in terms of pricing. But it's just, if you look at the market, it hasn't done much now this week. In fact, it's off. It's one of the few stocks that's actually off a touch for this week. It's just, is we now sort of getting back? It's had its run, and people sitting back and saying, okay, show us how they're closing the earnings. I didn't see that Telstra's done anything to change sentiment. I just don't know whether
nothing's really changed in that sense. So that's for that reason I can't see the negative momentum shifting anytime soon when it comes to the balance sheet or the operations.
Yeah. I think $2.70 or so got around those marks. That was a good time to buy Telstra. Now I think it's at probably the right price. It will go higher, but not much higher. That's my view on Telstra.
I think if you're worried and you want some stocks that might perform, then I think you probably would think about selling some. I think that would be my.
But Paul, what is the dividend still for Telstra?
Well, it's only 22 cents, so I think you've still got to factor in that dividend is going to come down again. If not this year, probably next year. Is that what you'll be taking into?
Look, it's already been cut from 30 cents. I think there's a fair big chunk, and there's a good chance, unless they can get those earnings coming through from some somewhere which no one really can tell us at this moment, then there's more likely to be downward pressure on the dividend. Because the fact is their dividend per share is more than their earnings per share, or fairly close at the moment. So it's in a tough position when it comes to the dividend and also its growth profile.
Okay, let me take you off internationally for a minute, Peter. Throw this one to you. Do you think it's time to look at emerging markets as alternative diversification?
Well, you know,
this is a question from Anthony.
Yeah. Well, we know Donald Trump and President Xi had a really good chat together, but tomorrow you might hear that all bets are off. You know, this happens with Donald Trump. Look, I'd rather wait for the midterm elections to be out of the way. I'd like to then see some kind of reference from Trump about a trade deal has been secured. I'm prepared to miss a 5% rise on it. And look, I'm thinking about buying the ETF that has the Chinese tech stocks in it, and that's the ETF I want to buy. I forget what the code is. But I don't want to buy it now. If I bought it now, I think I could get more downside. But I don't think it'd be much more downside because China has been completely rubbished over the last year or so. So I think that you're getting close to buying territory, and but I might miss the first 5%. But I want to make sure all the ducks are in a row.
Michael, emerging markets have any appeal for you?
Look, I mean, the divergence was enormous there for a good 3-4 months or so. If you recall back to last year when we had the synchronized global growth story, when that happens, a lot of money tends to flow out of the US into emerging markets because everything's doing very well globally. But we've seen the reverse occur, where the US has been the only bastion of strength, and there's been some question marks over the rest of the world. So you've seen money flowing out of emerging markets into the US. So I think as long as the US economy remains the beacon of strength and everything else relative to the US struggles, I don't see any reason why that trend will turn around. But it does look very, very cheap by historical measures relative to, say, the United States or the S&P 500. So I think you could, if you're allocating cash afresh, you'd be tempted to start looking at perhaps a little bit more into emerging markets than you would normally. But you've got to wait, I think, like Peter, for those signs that there is some money coming back into that area.
Yeah, I mean, I think I agree. I think when the US dollar is going up and that trend is still in place, other markets get smashed,
especially
emerging markets. And unless you think the US dollar is going to, the trend on the US, a stronger US dollar has stopped, I think you just wait.
And it's the right play at the right time, and I still don't think it's the right time.
Okay.
We're close, I think.
Ian asked a question about is this a correction, the start of something bigger, and should SMS be ready for heading for the hills and taking losses before things sit west? I think Ian, we've probably answered that, and I think we all see it as a correction. I mean, but more strategically, do you think this is a time to be starting to think about de-weighting from equities a little bit?
Yeah, I mean, for a long time, we've probably had 10 to 20% cash for a lot of clients. But I think you can rebalance within your portfolio, maybe out of some of the higher growth, higher PE into some of the lower valued or some of the ASX top 20, for instance. So you can just slightly play around the edges. But this whole thing of being all in or all out of the market is fraught with danger. I think history, looking at the statistics, shows that time in the market is better than trying to time the market. So that's the way that we've been trying to play it. You can tinker around the edges with a little bit of excess cash here and there, but I don't see the need to try and be picking cycles exactly as impossible.
Are you easing back a little bit?
Not yet. No? Look, because I do think there's a correction, and I do think, but look, I think 2019 I'll be getting more cautious because I do think if there's going to be a recession in the US, it's going to be 2020 or 2021. And we know the stock market will always try and anticipate this maybe 6 months in advance. They'll see the indicators coming through. So I want to get one more leg up for my stocks, and then I'll sell my growth stocks and I'll go longer dividend stocks. I might buy more Swits because it is a dividend play. And I know that I'm not going to go to zero. Look, I guess maybe if I get this wonderful insight that the market's going to crash, I might tell all you guys out there and go cash myself. But picking that is so hard. So my investment strategy is I don't really care what happens to my capital as long as my income coming in is really solid. And I think that's probably going to be
I wouldn't be taking out any margin loans or anything at this
No,
point in the cycle.
definitely not. Margin loans was 2009. Then you would have made a packet.
Yeah, I'm sort of just doing a little more cash. I mean, I'm going to use these buybacks as a chance to build up cash. I mean, I mean, we had Julia Lee in the other day, and she was saying, longer term, next 6 months, just increasing your cash weighting.
Yeah.
But I think I'm not getting out of the equity market, but I'm getting a little more, taking a little bit of money off the table, and just looking for the right opportunity. Okay, all right. I've got a question here from Celeste. We'll see if we can unmute you, Celeste. And I think the question we've got you, Celeste. Go ahead.
I'm just wondering what the panel's view on A2 milk would be, please. I get quite concerned when I see management starting to sell down their shareholding.
Yeah. Michael, I'm going to throw that one to you up front.
Yeah, look, A2 milk was obviously a real market darling there for so long, going from sort of $1 all the way up to $13, $14 there, I think, at some point. It's now settled a little bit. And the problem is with a company like this, although it continues to grow at a very quick rate, its growth rates are less than what they were in the past. So the market starts to recalibrate their expectations, and it just doesn't trade on as high a multiple as it once did. As I sort of touched on with the question on Bellamy's, when we were discussing Bellamy's, there are a lot of competitors starting to come into the space, and that is just basic economics. When there is so many profits in a certain area and when margins are so high, it starts to attract competitors to sort of eat into a piece of that pie. So with A2 milk, there's no doubt that their growth rates have peaked and they'll still continue to grow, but the question mark is, can they maintain these rates of growth? And I think that's a no at this point.
Yeah, the consensus view is it should be $11.75. That'd be an 18% rise from where it currently is. I think I agree with you, Michael. It really has had a big run. And it's been substantially higher than 11.75.
I think it was 13, 14 at one point.
That's right. So I think it's probably at least in the buying territory for someone who doesn't hold any A2 as well. But yeah, it's a tricky space at the moment.
I mean, I've had clients in A2 milk from sort of $1.50, but we don't obviously hold the same amount now as they did back then. There's been a lot of trimming going on along the way. And to be honest, most of the clients are now out, except for those clients that want to hold on just so they've got some exposure, because I just think there are too many risks on the horizon with that space, given the valuations, given the lofty levels of markets and rising bond yields, all those sorts of things.
Okay, all right. Sherwin S, who normally calls in, just asked for the name of the hybrid ETF. There's one from Beta Shares, its code is HBRD. I don't know if there's a second, but I haven't done a review on that, but that's the code. Okay, we've got another call here from Chris, if we're going to unmute that one. And go ahead, Chris.
Yeah, hi guys. No, I'm just curious. To what extent do you think that the market factors in a change of government in Australia? And I guess the reason for my question is that, well, I certainly have a very pessimistic view of what Labor's renewable madness might do to this country and to various organisations. And I'm just curious whether you think that the market shares that view and to what extent they might have already factored that into some of the declines we're seeing, or do you think that that's still not even being factored in at this stage?
Peter, do you want to go there?
Yeah, look, I totally agree that Labor's policies, I won't call it madness because I've got to be balanced, Chris, but I think they're going to be winners and losers under Labor. And the big problem is when you think a company's going to be a loser under a political regime, it stops you from actually making some good decisions. Like buying coal 2 years ago was based on the idea that I thought coal was on the outer, and coal is on the outer, but coal share prices have done fantastically well. I do worry about, I would be investing in renewables with Labor coming to power, and they're probably buys at this point in time.
And the impact on the banks, I think that was the main part of the question.
Well, you mentioned renewables as well.
Oh, okay, sorry.
Yeah. And certainly the banks as well, but I think the banks have been overbeaten up already. I see the banks going up before the election, but they will struggle once the election campaign starts. But remember, as you always say, Paul, they've got to get this through the Senate, a lot of their changes. I think a lot of their changes won't get through the Senate.
What do you think, Michael? Do you think a lot of it's factored in, or do you think we've got more?
I think we're definitely becoming, with the government, a lot more interventionist and a lot more populist. I mean, going back at the mining tax in the Gillard-Rudd times, and then even with this Liberal government, you've had the bank levy, you've had the energy companies recently, the Royal Commission. So it obviously plays into certain sectors more so than others, just depending on what's the flavour of the month in that respect. So I think it obviously has a negative impact on the market, but it's hard to work out the size of that impact because there are a lot of variables that go into determining whether the market goes up or down, obviously what goes on overseas, what happens with the US markets. But I think if you take a step back and look over a 50-year period in the market, there's always something that could be considered a negative, but the market tends to see through that, or tries to see through that at least, and then climbs that wall of worry. So you can't really beat yourself up too much trying to work out exactly what government policy is going to be, because over the medium run, it tends to level itself out.
Yeah, I mean, look, I just make two observations. Lauren talks about banks. I think there are bigger impacts in some other parts of the market. So, for example, bank hybrid shares, as I said. If you look at who's leading the campaign out there in dividend imputation, it's no surprise it's Jeff Wilson. Listed investment companies, those who pay big fully franked dividends, those trading at a premium, they are big targets in this. So I've written about that and said, if you worry about that, I'd be more concerned about some parts of the market than others. So, but I personally, I don't think this policy is going to change, right? Let's assume they get in, still got to get through the Senate. I think they'll change the policy and put some sort of cap.
Because even someone like Karen Phelps didn't support the policy.
Yeah, it's got to, like, there's so much noise about it. I mean, and I just think we've got such a long way to go. So, but you know, markets, you know, are going to get more and more nervous about Bill Shorten, I guess. But the question is, it's just so hard to know how much is factored in. I guess there's more bad news in the market sense to come first. Would be we're still 6 months out or so. So. But you've got to see through. I think things do level out over time. Is that? Do you think I'm just being an optimist in saying that, or?
Well, I find it very hard to believe that a future Prime Minister will really go out of his way to ruin the share price of banks, you know, particularly where they are now, because superannuation funds, including, you know, the industry super funds, would have a very big exposure to banks, and so he's got to be careful that he doesn't undermine, you know, his colleagues' industry funds. And there are a lot of just normal investors, whether they be retirees or not. He might have a hate session on retirees, but there are a lot of normal Australians, non-retirees, who have a heavy exposure to banks, either in managed funds or ETFs or whatever. So he's going to be really careful.
Okay, all right, another question just come in from Jennifer. I think will Paul be doing an in-depth report explaining the VHP buyback and dividend? I'll do that, Jennifer, so that'll come out.
Is that Monday for you, Paul?
That'll be probably Monday week, I think. So, but a bit closer to when the offer documents, I think they hit next Friday or next Monday.
Can we just throw one question to Michael? Once it's all been paid out, do you think the share price falls? Because I hung on my VHP shares because I was waiting for this dividend. Now I've got it. Do you think it'll fall after it?
Well, I mean, we saw yesterday everyone the stock was rallying in the morning, and then they sort of interpreted what it really meant, and the share price moderated a little bit. Does the share price fall? Possibly. Those that were looking to sell might have been waiting for this moment and to receive the cash, and they can use the opportunity to reduce their BHP. Because if you look at the underlying commodities, oil's come under a little bit of pressure, iron ore's off its highs. There are reasons to be selling or reducing BHP from a macro perspective. So I think there's a possibility that it happens.
That's a bit of my strategy, to think that it's sort of, they've had a great run, these resource companies. I'm not saying it's the end of the resource boom, but sort of, I think this is the time to sort of look at lightening off a little bit into these sort of rallies.
But Paul, for people who don't know, if you're holding BHP stock now, you're entitled to the buy. But if you buy it tomorrow,
no, too late. Yesterday was the last day for the buyback, but there'll still be a special dividend, which is another big dividend coming later in the year. So that's
another reason why some people hang on.
That's still 6 months away. But yesterday was the last day to buy BHP shares and be able to effectively offer them into the buyback. So okay, let's move on. Questions. Travel has been in the news this week.
Yeah.
CTD, Michael. Is this a stock that ever appealed to you?
I don't have any
This is a
clients
question
in there.
from Derek. Yep.
It's always looked interesting because the balance sheet metrics always look very good. But the share price looks very good, but it keeps always moving higher. So it's never had the opportunity to really pick up any. But it was interesting, the points that were raised regarding CTD. There have been a couple of people voicing their concerns with this business for some time and calling it out as a short, but it's managed to brush those off. It's too difficult to say whether they've uncovered anything earth-shattering. I think management have probably dealt with this better than some of the other companies that have been called out about with short reports in the last sort of 12 months or so. But I think time will have to tell with this one. Yeah. It's managed to sort of brush it off pretty well, considering. We saw a similar one with the Credit Corp about 6 months ago. That bounced back almost instantly. Blue Sky is the one everyone remembers because it actually brought that share price to its knees. But it's becoming more and more common, these particular short reports.
Yeah, well, I know Jerry Harvey complains about the short reports, and it's interesting that they come out from overseas. Yeah. But these guys are local, aren't they? So they're prepared.
Well, it was a pretty detailed statement. It was 200 pages or something.
Yeah, and they went to a whole lot of offices overseas, and that's why I think this has a lot more merit than some of the other ones, which are released overseas, which can't be.
Well, VGI is famous for picking out the Slater and Gordon issues, so this is why this one potentially has a bit more clout than some of the others that have popped up.
Okay, this question from Stephen: is Blackmores a buy? Blackmores, don't want to talk about Blackmores these days. Is Blackmores a buy around $123?
Yeah, the analysts don't like it at the moment. I think I'd like to see it go a bit lower before I get paid. I like Blackmores at 98 a year or so ago.
No, I mean, Blackmores, you can bundle that up in some ways with A2 Milk and Bellamy's, how they had their dream 12 months going back a couple of years, where I think Blackmores was up around 220. But again, the market just starts to extrapolate these rates of growth well into the future. And then all of a sudden, the company comes out with an announcement where growth rates fall, and then the market questions itself and then tries to recalibrate those growth expectations. And then the market re-rates the PE lower. I think that's what's occurred with Blackmores. They're still a good business. They're still growing okay. But the market had to just readjust what their expectations were for the business. And again, I don't think they're ever going to recapture the sorts of growth and margins that they were delivering sort of in that boom period.
Yeah, it was a real excitement factor.
That's right.
And they got to what, 220, 230.
And the Daegu trade that got cracked down upon by the Chinese authorities, that also slowed the rates of growth. And again, it shows the regulatory impost that some of these companies carry, that it can really change at the drop of a hat.
Okay, so we're not sort of jumping up and down about Blackmores. All right, a question from David about NEC, Nine Entertainment Company. NEC have dropped and are now recovering. Is it time to buy?
Look, Nine Entertainment, they're going with the merger or takeover of Fairfax Group. Again, when I look to invest, I look at the macro environment, what sectors of the economy are booming, what have a bright outlook. Something like old world media, old world print, I struggle to get excited about. So for that reason, I'll be steering clear.
Peter?
Yeah, I'm conflicted here because Nine Entertainment and Foxtel have joined together for the new Your Money channel, which I'm on.
Okay, well, if you could
but I will say that was an innovation in a sense. That I think these companies will come up with innovations. They do have a very big brand name. And I'll ask this question, because you are a little bit younger than me, Michael. But do you go to any Fairfax websites in the morning, like AFR, Sydney Morning Herald?
I do. I go to AFR, I go to Sydney Morning Herald and all of that. But I don't think
their brand is still alive, and I think they're in a position to do something at these low share prices. But once again, I wouldn't put any more than say 2 or 3%. Because they are at low prices.
I'm going to go the other way here. I'm with Michael on this. I wouldn't even think about old world media. Sorry.
Well, I mean, I went to the Magellan presentation the other day, and one of the key charts was the percentage of advertising spend on free-to-air TV, and it was always above sort of 40, 45%, and it was constant for a fairly long time. It's only really in the last 3 or 4 years where it started to taper off quite aggressively down to around 30%. And what's picking up is things like YouTube, where when you can do an ad and it targets a certain person that's actually interested in your ad, rather than just blanketing everyone on, say, The Bachelor or the cricket or something like that.
Okay, let's go to a question about Linus. Are you up at
Look, I'm familiar with Linus, but I don't know much about
it. Okay, I'm not sure I can help you here. Is Linus going to survive the Malaysian government review?
But the question the Malaysian government's there, I don't want to be in it. You know, it's the product of the future. But if you got a troublesome government,
that's the thing. I mean, Linus, they do have the access to rare earths outside of China. The only mine really in the world outside of China that can supply some of these things. So for that reason, they'll always have interest. But again, they've been having these to and fro's with the Malaysian government.
Okay, well, we can't help you on Linus. Okay, question from Alex. Stock I know nothing about. What's your opinion about PME, which is Pro Medicus Limited?
I know Pro Medicus.
Okay, Michael?
I've had clients in Pro Medicus. It's a bit of a hybrid company that it covers healthcare as well as IT, and they provide basically software and diagnostic software to various hospitals and clinics around the world. It's a company that's made the transition from being a loss maker to starting to really gain some momentum when it comes to their profitability. It is very expensive on a traditional PE measure, but obviously when a company goes from making a loss to just making a small profit, that PE is going to be exaggerated somewhat, and you'd expect earnings, if the momentum continues, to catch up over the next few years. So that's one that had a very good result recently, ran all the way up to about 11.50, has come under enormous pressure in the last couple of weeks, given the pullback we've seen, particularly in those high growth, high PE names, but it gives you potentially a chance to jump into something with a decent prospect.
Okay, we'll keep moving, Peter. We've got a few questions here. So let's just go to a question on Kogan. Can we unmute that one? From, I think it's Wynand. Is that Wynand? If I got that right, I do apologise. Your question on Kogan? Okay, that's what I'm mute. Yeah, there you go. Yeah.
Hi, gentlemen. Yes, Wynand is correct. I just wanted to know, with Amazon coming in, JB Hi-Fi was always going to be the one that copped it the worst, and Kogan was going to sort of leverage off that Amazon online presence, but they had a massive fall. Do you know what's going on with them? Is it a speculative buy at any point?
It's probably a speculative buy at some point. Michael, do you want to comment on Kogan?
They've got a very good marketing exercise going on at Kogan. They tell you that they're the ones to leverage off Amazon. I'm not sure if many people necessarily agreed with them, such as the analysts. The thing with Kogan is they've come out and had to admit that the impact of GST being charged to overseas purchases is going to now affect online shoppers. And for so long, Kogan managed to skirt those GST rules, which essentially mean they had a 10% advantage over many of the local retailers here in Australia. That loophole's been closed by the government, and therefore it's starting to affect some of their sales momentum online. I think one of the bells for this company was going back 6 months when management looked to sell down a big chunk of their shares, literally the day after an earnings upgrade.
Owners was even worse.
Yeah. So that ever since then, it's had a sour taste in the share market's mouth. And the most recent earnings downgrade, if you can call it that, was the sort of final straw, and that's what sent it down 30% or so.
So there has been probably an overreaction from the market because there's a lack of trust at the moment. The analysts think there's 97.8% upside. So even if they're wrong by a factor of 80%, there's a 10% gain there. You have to think that Kogan's still in a good space, being an online seller of all the stuff he sells. But I don't trust the management now, and that's my problem.
Okay, so then I think we've probably answered that. You wouldn't buy it, I think, Peter, is what you're saying.
Yeah, exactly.
Okay. All right, let's move on. This is one for you, Peter, from Sasa. I hope that's got that right. Do you think the December rally will occur this year? In other words, a Christmas rally, regardless of the outcomes of the midterm elections? Are we going to get a Santa Claus rally in the States?
Yep, I think so.
You think so?
Yep.
Okay. All right, any views on that?
I think so as well, considering we've had our clean out in October. Sentiment will tend to pick up towards the end of the year, and the majority of times there is a Santa Claus rally. But I think the fact that a lot of the macro and the economic data slows down a bit, a lot of the central bank activity slows down a bit, you're less likely to see the markets under pressure.
Okay, let's move on. I've got a few more questions to get through in the last 3 or 4 minutes. A question from Wendy: what's happening with Worley Parsons? Currently much less than the entitlement price, buy now?
Look,
What do you think of the acquisition?
Yeah, look, I mean, I just caught this acquisition. It's not one that I follow too closely, but obviously Worley Parsons had a takeover on the table from Dar Group. That never proceeded. This acquisition is looking to integrate vertically integrate the business, and obviously the market has some question marks over that. And often with these large scale acquisitions, the acquiring firm gets penalised by the market because it does increase the element of risk.
Yeah, I think even if it hadn't dropped, I don't know I'd be taking up my entitlements. I just get so nervous when you've seen a huge run up in the share price. Then they go and buy something overseas, and you think the odds of this working is, despite what they say, the track record of Australian companies is not very strong.
And also, it was a bit of a defensive play too, wasn't it, Paul?
Well, it's hard to know, but I mean, I'm just been so bitten in these companies.
I must admit, I haven't looked into that particular.
It's been disappointing.
All right, from a question on Harvey Norman and QBE, have you any views on either of those companies?
Look, QBE, I'll start with QBE. QBE has been a perennial underperformer. It's consistently disappointed the market. However, in saying that, the current market conditions of strengthening US dollar relative to the Australian dollar and also rising bond yields is a broad positive for QBE. Because if you think about what insurance companies are, they take your premiums and they essentially invest your premiums in fairly low risk assets. But over the last decade or so, those low risk assets have been yielding essentially nothing, making it very difficult for these insurance companies to make any investment returns. As well as that, in Australia in particular, we're starting to see insurance premiums increase for the first time in a long time across the industry. A lot of competition came in from overseas there for a decade. And then what ended up happening is it pushed the premiums so low that no one can make any money, that a lot of those foreign entrants have now left the industry. So there's a number of positives moving in QBE's favour. But I wouldn't buy it because I don't like it.
And the last question before I just close off.
I like both, by the way, HV and HQB.
Okay. Is Dulux have a good old Dulux?
Dulux, it's lost a bit of its momentum because
of its gloss.
This is a question from Chris.
Well, there's a lot of brand loyalty to Dulux. Again, there's foreign entrants came in, some from Japan even, that were really putting pressure on that paint market, but they've also now left the industry. The housing market's obviously come down a little bit, but what tends to happen is if you're not buying a new house, you might do a bit of a renovation or do up the granny flat.
It's a reasonably low risk industrial.
Exactly, and that's why it hasn't been so volatile, even despite the fact that many of the other housing related stocks have pulled back.
Yeah, you can have a look at that if you're looking for something a little bit less volatility. I think Dulux, I'm not saying it's a buy right at the moment, but it's in that sort of category. Okay, let me just deal with some other ones very quickly, because we said I want to ask you, Peter, about the US tonight. So Liz, you've asked a question about rising interest rates, volatility, and franking credits, what it means for REITs. Normally rising interest rates would be bad for REITs. Volatility should be good for REITs, and franking credits, you'd say, would be a positive. That's when you say franking credits, you're talking about the ALP changes. REITs are actually doing pretty well this year. I wrote an article on that the other week. They're actually, in the earlier first chart we showed you, that's one of the sectors in the green. Commercial property is still very strong. So I think if you're looking at REITs, I think there's some good stuff in the commercial property side. I'd be still very wary about retail exposure. Do you agree with that, Michael?
Yeah, absolutely. I mean, also a lot of them are real estate investment trusts, and trusts don't actually get franking credits. So you've got to be careful and pick the ones that
I think it's Labor change is actually a positive for the REIT market.
Right.
Is that?
Yes, 100%. As well as, look, they had been under pressure because of rising interest rates, but as you saw last month, as Paul touched on, that was actually one of the better performing sectors. Although it was down, it outperformed the broader market because it is a bit of a safe haven.
Okay, and then there's another question. Other thing is the ETF that Peter was referring to. I think one of the ones was Asia. That's from Beta Shares. That's one of the ones that you can track some of the Asian technology companies. There's also some that if you on the US market that'll probably give you better exposure. You get that on some places. And there's a couple other questions. I'm sorry that I haven't addressed directly, but I think we've picked up questions. There's one about the banks, and finally one from Josephine. Any renewable stocks that you like, Michael? Just the last
off the top of my head. A lot of them are quite small.
Energy,
I do have a couple on my computer back in the office that I look at when clients ask these sorts of questions, but I can't think of any off the top of my head.
We should get him to write a story on renewables for the Switzerland.
We should.
It's not my area of expertise.
Vicky, you asked me a question about the Qualitas and their LIC. I'm not familiar with that one. And
Qualitas, I know Qualitas.
But sorry, and the new LLC, I'm not familiar with that. And also a question about IPO wealth. We would suggest that rates are interesting, but that's in the higher risk side, so you should look at that carefully.
Yeah, I interview the CEO of Qualitas on my Money Talk show, so I guess if they go to the Sky News, so
have a look at Your Money on Sky News. They're probably, and now Channel 95, free to air, and they probably have it online, a video on demand.
I'll be on the website for sure.
Yeah, and you'll be back on that on Monday night, Your Money, 8:30 p.m.
That's right.
Channel 95, free to air, and Foxtel.
Exactly.
Just to finish, Peter, because we're right on the dot of 1:30 tonight. US employment numbers.
I think it'll be another good number.
Another good number.
Yeah, and I think the market will like it. You put together Trump's love-in with President Xi. I think it sets us up for a lovely November, December.
You think it's Michael? It's a big number tonight because I'll be worried about wage.
Average hourly earnings is probably the key thing to look at. It's been slowing a little bit, the momentum in the inflation and earnings, so that will be the key thing to look out for. But I don't expect a huge swing either way, just basically in line with expectations.
All right, well, we're right on 1:30 Eastern Daylight Time. I said we'd finish by then. So, Michael Wayne, the Managing Director of Medallion Financial, thank you. You've been a great guest on our Switzerland.
He can come again.
He can come again.
Thanks for having me. I appreciate it. It's always fun.
He done a lot of homework. Peter, you, of course, thank you. You'll be, subscribers can read Peter's thoughts on the US market tonight and analysis of the US employment data and back on Monday. And, of course, our regular edition out on Monday. So, on that note, I'm going to sign out. Thank you for joining us. Have a great afternoon. And we'll be back at the same time on the first Friday in December. Thanks for joining us on our November Switzer webinar. Good afternoon.